Alright, so let's talk about one of the most interesting, and honestly one of the most controversial projects, Pi Network. If you've spent any time on social media, you've probably seen someone talking about it, telling you to download an app and start mining Pi coins for free on your phone. For years, this project has been in a sort of pre-launch phase, building a massive community of over 55 million users, all tapping a button on their phones daily. They've been accumulating coins that had absolutely no monetary value, a promise, a vision. Then, something strange happened. A price appeared. Out of nowhere, various exchanges started listing an IOU version of the Pi coin, and its value began to fluctuate. As of today, August 24th, 2025, that price is hovering around 36 cents. This has created a massive wave of excitement and a ton of confusion. Longtime miners are wondering if their digital dust is finally turning into gold. New investors see the low price and massive community and think, could this be the next Shiba Inu or Dogecoin? But here's the catch, and it's a big one. The Pi Network's mainnet, the actual blockchain where mined coins become tradable, is still not open to the public. The coins trading on exchanges are not the real withdrawable Pi coins from the app. They are essentially IOUs, placeholders. So the question is huge. Is buying this Pi IOU at 36 cents a genius move, getting ahead of the market? Or is it a very risky gamble on a project that might never fully launch? In this deep dive, we're going to break it all down. Let's get into it. So, to really understand if Pi is a good investment, we first need to get a handle on what it actually is. Pi Network was started back in 2019 by a team of Stanford graduates including Dr. Nicholas Kokalis and Dr. Chengdiao Fan. Their big idea was to create a cryptocurrency that anyone could mine easily, right from their smartphone, without draining their battery or needing expensive machines. You download the Pi Network app, create an account, and tap a button once every 24 hours to prove you're an active user. They call this mining, but it's not mining like Bitcoin. No massive farms or GPUs. Instead, your phone helps secure the network via trust circles. Invite people you trust to validate transactions and help secure the ledger once the network is operational. It's a social network-based security model. This model has been incredibly successful at one thing: user acquisition. Pi has amassed a colossal user base with estimates over 55 million pioneers, but the project has been in an enclosed mainnet phase for a long time, a live blockchain firewalled off from the outside world. Users who complete KYC can send and receive Pi within the Pi ecosystem and use a few testnet apps, but they cannot yet connect to other blockchains or sell their coins on external exchanges. If people can use Pi to buy goods and services inside a Pi ecosystem, that could create real sustainable value. But that's the missing piece right now. For now, the massive community remains Pi's single greatest asset. This cautious, slow approach is both a strength and a major source of frustration for users. This is where things get really confusing, so let's clear it up. The Pi coins that you mine on your phone cannot be sold or traded on any public exchange yet. Some exchanges, CoinMarketCap, HTX, Bitmart, show Pi listings, but the answer lies in something called an IOU. These exchanges created tokens that represent the promise of a future Pi coin, a financial workaround driven by speculation. The IOU price is driven purely by supply and demand on that specific exchange. It has no direct link to the Pi network's fundamentals or mined balances. When first listed, speculative frenzy sent prices to unrealistic highs, reportedly over $300 on some exchanges. And then it crashed. Now it has settled around 36 cents. That price is real in the sense it trades, but it's completely disconnected from the actual Pi app balances. The Pi core team has warned these listings are unauthorized. Buyers are taking on a serious counterparty risk. If mainnet opens and exchanges can't back their IOUs with real coins, traders could be left holding worthless tokens, or exchanges could settle in cash at a much lower price. That disconnection between IOU markets and the project's fundamentals is the core risk behind the 36 cents price. For a project developing slowly for years, any sign of progress is huge. Recently, Pi concluded a major online hackathon that generated significant buzz. A hackathon invites developers to build dApps on a platform, a critical test of whether the ecosystem can support real-world utility. Submissions ranged from e-commerce marketplaces, social apps, casual games, to fintech tools, many still prototypes but tangible steps toward utility. Some winning projects showed promising user flows for buying and selling with Pi. The event drew global participation, a positive sign that developers are interested in building on Pi, not just miners accumulating coins. A marketplace or payment app could create internal demand, the missing link for real value. The hackathon acts as a small, de-risking event. It shows active development and builder interest, nudging the project from theory toward practice. If more useful apps appear, the case for opening the network widens. This doesn't guarantee success, but it's a signal that the project may be maturing. One piece in the larger investment puzzle. Now let's get into the exciting part. The bull case. Why might someone see the 36-cent IOU as a buying opportunity? Reason number one, sheer scale. 55 million engaged users gives Pi an unparalleled distribution. Accessibility and ease of mining have put coins in the hands of people across developing nations. A potential base for mobile microtransactions and remittances. If apps emerge that facilitate payments, the internal demand could be substantial. Another argument, low price of entry. At 36 cents, the token feels cheap compared to its speculative peaks, creating an asymmetric risk-reward for small bets. A small speculative stake could yield large multiples if the project succeeds. Finally, the team's cautious approach, focusing on KYC, infrastructure, and app ecosystem, may produce a more stable, sustainable network long-term. The hackathon is evidence the strategy could be working, so the bullish case, massive community, potential for real utility via apps, and a low-cost asymmetric bet, reasons some investors find 36 cents attractive. Alright, we've looked at the bright side, but now it's time for a reality check. Investing in Pi IOUs comes with very serious risks. Go in with your eyes wide open. The biggest red flag, mainnet, still not open. The project has been in development for over 5 years with no firm public launch date. Launch conditions like KYC and migration goals can feel like moving targets, creating uncertainty. The IOU itself is a major liability. These tokens are not endorsed by Pi Core, and exchanges may not acquire enough coins to honor them. Exchanges could delist the IOU or settle in cash, potentially at much lower values. Tokenomics are uncertain. Supply could be massive, hundreds of billions. And when mainnet unlocks, immense selling pressure from millions of free miners is likely. That could crash the price well below 36 cents. Plus, to claim mined coins you must complete KYC with a third party, a centralized, privacy-sensitive step that could undermine trust. These are fundamental risks. To evaluate Pi, it helps to compare it to other projects in crypto. Pi is unique, almost a strange creature among cryptocurrencies. Electroneum tried mobile mining but never scaled like Pi. WorldCoin focused on identity with controversial hardware. Pi's edge is distribution, not proven token economics. Compared to Bitcoin and Ethereum, Pi has no battle-tested security, no DeFi ecosystem, and no open market presence. It's not competing on tech, but on distribution. Pi's strategy is mass distribution. If that network effect converts into real economic activity, it could be powerful, but that remains unproven. So you're betting on users turning into a market, not on revolutionary technology. So the ultimate question, should you buy the Pi IOU at 36 cents? Let's break down the arguments for and against in simple terms. The core argument for buying is a bet on the future, that Pi will launch an open mainnet, that 55 million users will create economic activity, and that exchanges will honor IOUs. If those things happen, buying at 36 cents could look genius in hindsight. But the reasons to stay away are real. No confirmed launch date, unauthorized IOUs, exchange risk, and massive potential selling pressure from free miners. You could be paying for something millions got for free. Who will be your competition when it's time to sell? If you have a high risk tolerance and a small speculative amount you can afford to lose, treat this like a lottery ticket. If you prefer proven projects, stay away for now. Don't invest money you can't afford to lose. After everything we've covered, what's the final verdict on the 36-cent IOU? Pi Network is not for the faint of heart, one of the most speculative plays in crypto today. It is not the next Bitcoin. It's not a guaranteed path to riches. View it as a high-risk, long-term gamble on a unique, unproven strategy for mass adoption. Think of it more like a VC bet on a startup than a traditional crypto investment. If you prefer proven tech, active ecosystems, and clear roadmaps, stay away. If you have speculative capital you can lose, this might be an interesting asymmetric bet. The hackathon suggests the project is not dead, just slow. That's why some see a small bet as reasonable. Don't take loans or bet your life savings. Treat any purchase like a lottery ticket. The Pi Network's journey is still unfolding. It will be fascinating to watch.